impatient with winning trades, be enormously impatient with losing trades. That's what most traders don't do, holding on to so holding on to loss-making positions and selling winning trades early. Do you want to talk about that?
Yeah, and again we're going back to loss aversion here. The tendency when we're losing money to be more risk-seeking, and when we're winning money we become more risk-averse. Hence, if we're in the money we will take the profit, but if we're out the money we hold on to it in the hope that it turns back to a profit. That's very bad advice. The advice is usually the other way around. Ride your winners and cut your losers. Now, if I go back to my method of trading, where I probably, as I say, 80% of my trades were probably losers and 20% were winners. Very quick to cut. When you have that sort of, you could have a run of 20 losers in a row, even more, in those sort of circumstances. So you've got to preserve your capital. And you have to be quick to cut. When you have a winning trade and it's going with the trend, it's going with the strength, as we talked earlier on, you really want to capitalise on that, add more to it, put more capital on that trade. The idea is you've discovered something that's moving, that's got some momentum. So you want to put your money, your chips on there. I'm going to bring in another gambling analogy here. I don't know if you've read the book by Ben Mizrahi, Bringing Down the House. Okay. There's some great analogies in there for trading. That team from MIT, it was in the film 21 as well, their strategy was having people on the table playing small hands all the time. But when they suddenly had the cards in their favour, their edge, they'd signal for someone to come in who was standing around, he'd walk in and he'd go heavy on that trade. And basically what they're doing is they're putting the money where the edge is. So what you're doing as a trader is you're looking to find an edge. You're looking to find a trade that's got momentum. You're looking to find something where the odds of you winning are far greater. And when you find that, you want to put your money there. In the meantime, playing the small hands is just like putting in the ante. You have to keep the ante small. So you have to keep loss cutting. Now it's actually counterintuitive, but that's what works in trading.
It was a cracking film, wasn't it?
That was a great film, yeah.
Great story as well, yeah. Did you make any studies as to why investor traders tend to add to losing positions, averaging down even if it's likely to lead to ruin?
I haven't made a study, but I've read a lot about it, and I've met a lot of traders. Well, actually, I haven't met a lot of traders that do it. I've met a lot of traders that did it early in their career and said it was a great learning for them at some point. The reason I probably don't meet many traders that do it is because they don't survival of the fittest. They don't get through boot camp. As I mentioned, there's one guy who does it now, but it fits in with his structure of his trading. And he's very disciplined around it. So that's a rare skill. Most people do it. I think it's almost something intuitive. There's something intuitive about, well, if I bought my first lot at 100 and I can buy more at 90, if I thought it was a good buy at 100, now it's 90, it must be an even better buy. And now it's 80, God, it must be even better. And I'm averaging in now at 90 because I bought 100, 90, 80. So I've got myself into a better level. That's almost intuitive, but actually it's the wrong way of thinking it. And I don't know if you've read the loss aversion, the work of Kahneman on loss aversion. He says when we're losing money, we tend to be more risk-seeking. And when we're making money, we tend to be more risk-averse. So there's a lot of these traders or people in general, tend to become more risk-seeking when they're losing money. And one of those things they do is they double up, or they add to losing positions.
So that sort of leads you into do more of what is working and less of that which is not. If it's a strong market buy, if it's not, converse, new highs are to be bought, new lows to sell. What's the logic of all that?
The logic is go where the strength is. If something's going up, there is a tendency again for young traders. If something's gone up, there's almost this intuitive sense we'll sell it because it's going to come back down. This sort of regression trading, regression to mean. But that's not how markets work. If something's going up, there's a reason why it's going up usually. People value it and people think it's going higher. It doesn't always work, but markets move in trends. They don't move straight from one level to a new level. It's a journey. And you always want to go where the strength is, or if you're short selling, go where the weakness is. Because that's where the money's going.